Dollar General is a retailer that is thriving in the American retail space, with a focus on generating profitable growth while maintaining its reputation as a low-cost provider and exploiting expansion opportunities. The corporation intends to accomplish this by increasing stores' in-stock levels, consistently providing goods at low prices, and investing in low-cost labor. Given that their target market is households with annual incomes of less than $40,000, one might wonder how they manage to turn a profit at all. In this video, we'll look at Dollar General's history, business strategy, and strategies for maintaining profitability while serving low-income customers. Their origins, which date back to the 1930s, can be traced back to the 1950s. I'll go over all of that in this video. First and foremost, J.L. Turner is to blame for how they ended up here. He had a somewhat sad job during the Great Depression because there were many general stores at the time and they were struggling due to low consumer spending. Many of them are on the verge of bankruptcy. J.L. would look for companies that had declared bankruptcy, buy them at a discount, and then simply liquidate everything, as I previously stated. But I suppose he was turning a negative into a positive by figuring out how to profit from the bad economy. Cal Turner, J.L.'s son, was a teen at the time when the economy began to sputter in 1939. J.L. decided to abandon that venture in favor of launching a wholesale company that would supply dry goods to the remaining general stores and other retailers. They co-founded J.L. Turner and Son Wholesale. Despite not being the most creative name, it conveys a lot of information. After a few years, they changed again, abandoning the wholesale model in favor of the retail model. This indicates that they moved from supplying goods to the stores to acting as the stores themselves. And they were successful. Over the next 10 years, their department store chain expanded dramatically to 35 locations. They began to define themselves and evolve into the company we know today at this point. Because there was no such thing as a dollar store at the time, it was a brilliant idea. The Dollar General store was built with the idea that everything would cost less than $1. It became an overnight success over the next 10 years. They expanded throughout the Southeast by adding 250 more stores. By 1968, they had significantly expanded, and the Dollar General store had essentially taken over their entire operation. As a result, they renamed the company Dollar General and held a public stock offering. That is how it all started, but the 250 stores in the Southeast paled in comparison to the 15,000 outlets we now have in 44 states. The majority of their success prior to the 1990s can be attributed to acquisitions. It was really just a matter of expanding on an idea that had already been proven to work well. They entered one new market at a time by smartly acquiring a somewhat comparable regional chain of stores. Notably, they put $8.2 million into this 88-store Arkansas network of United Dollar stores in 1977. In 1983, they invested $50 million in the 280-store P.N. Hirsch Company based in St. Louis, and another $30 million in the 200-store Eagle Discount Network based in Florida in 1985. Those three acquisitions accounted for nearly half of their 1,300 locations at the time. But those three acquisitions cost them nearly $100 million, and by the end of the 1980s, the company realized it was overspending, and its investors were losing faith. As a result, they slowed down and began opening more of their own stores. This change was significant for them because it gave them more control over the locations of new stores during this time period. Large discount retailers, specifically Kmart and Walmart at the time, were by far the largest competition for just about any company. Competition grew more intense over time. They later came up with a fresh strategy to continue growing their company. Their plan was to set up shops in communities with lesser incomes. This is the reason Dollar General has never been considered a high-end, upscale retailer. It is intended for those with lesser incomes or fewer options. Their strategy was to set up shop wherever other large businesses were not. This necessitated the establishment of stores in low-income or sparsely populated areas. They continue to identify their primary customers as low and fixed-income households that are frequently overlooked by other shops, demonstrating how successful their strategy has been for them. In response to the question of why they are successful, I would argue that this is a major factor because they also revealed that 75% of their stores are located in communities with a population of 20,000 or fewer people. We've all heard about the disappearance of the middle class. This actually increases the number of lower-income people, which benefits Dollar General by bringing in more customers. According to the CEO, our core client, defined as individuals with family incomes of less than $40,000 per year, is continuing to grow as a result of the economy. He also mentioned that they have been able to open new stores in communities that were not as impoverished a few years ago. In summary, their consumer base is growing, which has aided sales. Consider how much it costs to start a new business in a small town versus a major city, or in a disadvantaged area versus a prosperous one. Because these are low-income neighborhoods, it is easier for them to open these new locations. In 2018, they surpassed the 15,000 store mark by adding an average of 2.5 sites per day. This is 3 times the number of stores that Walmart has in the country, all of which are in the United States. Walmart has them beat in terms of overall square footage, with each one averaging over 100,000, with the biggest difference, of course, being the size of the stores. Dollar General, on the other hand, is only 74,000. Consider how much less expensive it would be to open a Dollar General in a small town rather than a Walmart in a larger city. I should mention that, for lack of a better term, these are also fairly basic stores. People frequently shop at Dollar General because it is either cheaper or closer than other businesses that compete primarily on price and convenience, making it feel like a mandatory stop. This means they don't have to impress you. These stores could be old and disorganized, or have bad customer service, or anything else you can think of that leads to a bad customer experience, and it doesn't even matter that much because it all helps to explain how they've been able to grow so big while keeping their costs low, and presumably pass the savings on to the buyer. That brings me to another point, which I'd like to highlight: Dollar General, which is thought to be the first dollar store ever. Today, however, almost nothing is still sold for $1. At this point, it becomes a little manipulative. I like to think of this as the polar opposite of Costco because Costco sells large quantities at low margins, whereas Dollar General sells small quantities at high profit margins. Their business is more profitable than Walmart, Target, and the majority of other well-known retailers, with a gross profit margin of more than 30%. However, this is frequently due to them selling fewer units than other companies, in which case you will typically pay more per unit. It deceives the buyer into believing that something is inexpensive. Consumables like food, soap, and other common grocery items account for the majority of their sales, but they also have the lowest profit margins. As a result, everything else is likely to have a margin far greater than 30%. Dollar General has been one of the largest retail success stories in recent years as a result of focusing on customers who other retailers overlook. Their strategy has always been to concentrate their efforts in low-income and sparsely populated areas. But look at how well it's worked over the last 30 years or so. Some of the benefits of that strategy include a growing client base, lower rents because they open small facilities in undesirable areas, and lower overall expenditures. When the firm's targeting of clients who are compelled to purchase there is combined with the fact that it also sells in small quantities, it can explain why the company has seen success and growth for nearly 3 decades without interruption. That's all I have for today's video about Dollar General. Please leave a comment if you've ever shopped there. Did you enjoy their stores, and how are their stores managed? With that, Visionomics, signing out.